We had 13 straight days of losses for financials going into CCAR. We have them in a rally mode today. Jim, what do you make of this?
Well, I think the bigger picture is, what does CCAR mean? Obviously, the bulk of banks had their capital return plans approved, but what I noted is a lot of the banks were approved to give payout ratios above 100%. So what that's telling me is that prior year CCARs may have been too conservative, and they're being allowed to give back capital that they had previously been required to retain. There's obviously a lot of political pressure to end CCAR, and I think that what you're seeing from today's results, or rather yesterday's results, is that end may be closer coming than we may think.
For those who had been overweight financials all this year, waiting for that outperformance of the S&P 500, JJ, are we going to take a look back and say, that marked it? That was a time, that was a catalyst for financials to go higher.
Well, I really think it is, Melissa. And what's really interesting to me about today's action particularly, as we know, Goldman Sachs and Morgan Stanley were the two stocks that were only able to give the amount they gave last year, not above that amount. And it's interesting that they're down today because the root cause of that was actually because of a one-time tax charge. Right. So I think that when I look at those two stocks, this really surprises me that Wall Street and investors in general aren't overlooking that. But overall, if you believe that we are going to continue growth, that tariffs won't slow us down too much, particularly in Europe, I think that financials are certainly an area you have to continue to look at to be a market leader.
Are you a believer in that? Or is the jury out?
I think the jury's still out. I think we're going to continue to see a lot of negotiating through Twitter and the media for the next month.
Josh?
I disagree with all of it. I really don't think, I don't think CCAR is a major catalyst for the sector. I understand that maybe there's a little bit of a bounce here today, and I'm not saying that bounce can't turn into something better. These stocks have certainly been out of favor pretty much since February, almost in a straight line. But there is nobody that was looking at CCAR like it was a question mark. Everyone understood that the major banks, with maybe one or two exceptions, shout to Deutsche, we're in great shape. Like, there's no one that was like, ooh, I hope they'll be able to pay a dividend.
Although Deutsche is doing a lot better than a lot of the other banks.
Hold on, let me just finish the thought, because I think it's important. What's been ailing the banks had nothing to do with how much buybacks, how much dividends they'd be able to complete 2018 and beyond with. What's been ailing the banks is still in effect, and that is a narrowing yield spread. And this is gradually becoming a bigger and bigger threat to the potential for seeing these companies, and I don't mean all financials, I mean this narrow cast view of financials, the big guys in the XLF. That has not changed. I don't know if it's going to change, but that is the issue, and that is why I'd rather own your stock. I'd rather own TD than any of the big banks in the XLF. I'd rather own the brokers, some of the asset managers. I'd rather own credit cards. I'd rather own payment processors, anything but the mega banks, just because of CCAR. Now, I own JP Morgan. I've owned it for a while. Not a seller on that narrowing spread, but I just want to be clear, CCAR is not the reason why these stocks sold off or why they should bounce.
You bring every bank analyst on, and they'll say that the narrowing spread doesn't really make a difference.
Until it does.
Until it
does.
You mean until
now? We don't have
now?
a credit problem. By the way, the good news is we don't have credit spreads blowing out, which would make you say, okay, I'm bearish banks, but you are not getting any help on net interest margin from credit spreads. And in fact, you may be getting to the point where people start using the R word if this current trend continues.
The one thing I got to say on that, I understand what you're saying, that this in itself may not be the catalyst, but it gets people back to buying the financials. I feel like today, but I feel like overall it hopefully keeps people there, because I think it got a little bit overdone to the downside, Josh. Yes, we built in this expectation of rates at 3% and above, and I don't think there are many people in the world who didn't expect us to be between 3.25 and 3.5 in a 10-year at this point in the cycle. But I feel like banks got punished too much to the downside.
Show me the Fed take its foot off the gas a little bit, and long-term rates rising a little bit of steepness, coinciding with continued good economic data that we have been getting. The banks will go up 20%, every one of them.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.